afternoon. Happy Friday. This is Sean LaBelle of the Decker Hewitt Group. It remains a volatile market here so far in 2022 with North American indices right now selling off a little bit on this Ukraine-Russian crisis. We haven't quite retested the lows that we did see mid-January, but we're getting pretty close. So the market's in a bit of a consolidation phase right now, looking for clarity either on the Russian-Ukraine crisis or the U.S. Federal Reserve and, of course, its rate hike cycle. And of course, inflation's obviously tied into that commentary quite a bit. So this week's Market Watch Weekly focuses on both of these narratives right now. And there's an interesting table in there that just pulls up all the geopolitical crises dating back all the way to Pearl Harbor 1941. There's about 20 instances in there. And for the most part, this isn't necessarily something that's going to dictate the direction of markets over time. The average pullback for any of these given events has been around 4.5%. With the average duration of weakness, it was around a month, with a full month as well in terms of the recovery time. So again, this isn't necessarily something that's going to dictate fundamentals, which is of course what does drive the direction of markets. So speaking to that point, inflation is obviously front of mind right now. It isn't quite eroding into corporate Americans' earnings as we've seen so far in this earnings season. Companies, however, are not being rewarded with a good earnings report. The market is mainly right now focusing on the Russian situation, along with inflation, which continues to run a little bit hot. But again, in this week's Market Watch Weekly, we provide an interesting table in there that does show that we might have peaked in December, January in terms of inflation numbers. There's some data coming in that would largely suggest that the bottlenecks that we're seeing is starting to reside a little bit. So this is why economists and strategists are largely constructive that inflation should slow down in the back half of the year, which is why the U.S. Federal Reserve believes it doesn't necessarily have to be as aggressive as some might think it needs to be in terms of the rate hikes in the coming months here. But we are definitely pricing in rate hikes for probably the first 3 months starting in March. So do expect the market to try to digest that as we continue to go forward here in the coming weeks. We'll end it there. Hope everyone enjoys the long weekend, and we will talk to you again next week. Cheers.